telling me that you have a way to defer the tax situation there? Is that what you're telling me?
Yes, absolutely. Yes. And so the first one I was referring to is a 1031 exchange, which only applies to investment real estate. The second one I'm referring to is called a deferred sales trust.
A real eye opener to see that there are ways that people can use the regulatory framework, if properly structured, to invest 1031 exchange dollars in things that you would not think were like kind to what they exited from.
I'm going to pause that real fast because I think my thing is not showing quite up as it should. Okay, let's just kind of replay that.
Are you telling me that you have a way to defer the tax situation there? Is that what you're telling me?
Yes, absolutely. Yes. And so the first one I was referring to is a 1031 exchange, which only applies to investment real estate. The second one I'm referring to is called a deferred sales trust.
A real eye opener to see that there are ways that people can use the regulatory framework, if properly structured, to invest 1031 exchange dollars in things that you would not think were like kind to what they exited from. So it was very impressive. I got to say, you are the first one I've seen pull this off, and I'm pretty hesitant to believe in a lot of these kinds of things. So it's a major feat for me to say, wow, this actually really worked, and it was really cool.
1031 is a way to shelter your income when you sell the thing. The DST is a way to avoid the 1031 and not have to suffer the time penalty.
Our career and during different tax periods, we've seen, these tax avoidance, tax minimization, offshore, all these different strategies undertaken to minimize or avoid taxes. And then I can tell you that, some of them are just not worth the trouble. And so I was skeptical. Admittedly, I was skeptical. I thought, oh yeah, here we go, another one of these, right? And then they say, no, it really is different, right? So look more closely. We looked more closely. We had, honestly, 2 years of conversations. 2 years. Now we were being due diligence at the same time that we were doing due diligence, but 2 years is a long time to be, sort of flirting with the idea of and getting to know the people and getting to really understand the transaction. Yeah, long story short, we got comfortable, although we are not tax attorneys, lawyers, or estate planning attorneys, that at least, from an investment perspective, that, it made sense to sell a highly appreciated asset, get liquid, hold that in this type of a deferred or installment sale type of instrument, and then just be in a position then to do the most important thing. I'm probably stealing your next question, which is time. They say, well, you can't make more time. You can. The Deferred Sales Trust, in a way, allows you to lengthen the investment time horizon for those assets after getting liquid, but before having to feel the tax impact. And from an investment manager's perspective, time horizon is the most important element in investing.
All right, everybody. Hey, welcome to another Capital Gains Tax Solutions Cryptocurrency Deferred Sales Trust Mastermind. For those who don't know, I'm Brett Swarts, and we're very passionate about helping people make all things simple, the Deferred Sales Trust, and helping you create and preserve more wealth as you exit highly appreciated businesses, real estate, cryptocurrency. It could be a primary home. It could be saving a failed 1031 exchange. And we're here to do a couple things, give you kind of the vision for who we are and what we're trying to do, as well as tell like a deal close story of the week, and then answer it and open up for questions for everybody who might be tuning in for the first time, and maybe trying to clarify if this is a good fit or not for them or their clients. I'm welcomed by a couple of my business partners. They're actually on the road today. One is the Jake Muller, and one is Pierce York. Guys, how are we doing today? I'll start with Jake.
Doing great, Brett. Having a wonderful time. Just getting back from Texas. Was at a Bitcoin conference in Houston, and representing also one of our clients, Moonshot, that does the electrical infrastructure and data center type arrangement for those that mine Bitcoin. So that was all very exciting.
That is very exciting and very cool. And Pierce, where are your ventures taking you today? If he's available, he might be on the road.
Yes. So we're heading up to beautiful Tahoe to just get after it a little bit on the golf course and enjoy the celebration of the youngest brother taking the plunge and getting married.
Fantastic! Congratulations to Pierce's younger brother. You got to bring him to the mastermind after all the festivities wind down. And Jake, for those who want to know why we're here, can you give a little bit about the vision in your own words?
Absolutely. All of those people that have highly appreciated capital assets that are going to be sold, or otherwise exchanged for value, and would otherwise incur capital gains tax. We are here to help them or show them how not they can defer that forward and continue to reinvest the gross proceeds minus attorney fees rather than chopping things up and separating them early on to the various taxing entities.
Perfect. Exactly. And so we do that through something called a deferred sales trust mainly, although there's some other strategies too that can have worked for a long time, especially a 1031 exchange when it comes to real estate. We just have found there's some limitations to the 1031 exchange, especially because it doesn't work for cryptocurrency, doesn't work for businesses, doesn't work for highly appreciated public or private stocks, whereas the deferred sales trust, it does. And the analogy we like to use is something called Netflix versus Blockbuster. And if you remember going to those old Blockbuster video stores, and they'd have the video at the end of the aisle, but if you got that video, you had to return it within 3 days, or sometimes it wasn't there, or if you didn't rewind it, you get a little fine. Well, that's like the 1031. It's very restrictive. You have that 45 days to identify, 180 days to close. It oftentimes creates pressure where you're not diversifying. You're taking on too much debt. You don't have enough liquidity. And we believe today, more than ever, it's a great time to have some debt freedom, to have you be able to sell high and being able to get some diversification, whereas the 1031 oftentimes doesn't allow you to have any of that. And oftentimes you're selling high and buying higher. So the deferred sales trust can come in and help you or help your clients defer capital gains tax, again, on cryptocurrency, business, real estate, and not have to suffer the time consequences of overpaying for something. And so I just think about what's happened recently with a couple of the deals that we've closed. Bitcoin in particular, we had a client, Jake and I, who bought Bitcoin at about $50,000 and it went up to 50 million. And this huge amount of gain wanted to exit, and we exited a part of that at 54,000 a coin, about 5 million of the 50 million, and deferred about 1.85 million in tax, which was a big opportunity for her to then deploy a majority of the capital into a business venture, all tax deferred using the deferred sales trust. And so those are the type of things that we're helping people every day. We like to use the analogy of a Rubik's Cube, and the more brains in the mastermind that we can get in the room to take this cube that perhaps has all different colors and is out of sorts, that we can together move and try to get it as congruent for each circumstance as possible. But Jake, I got to be honest, it's not always that easy, right? Because sometimes we're up against timing restrictions and maybe even qualifications. So who would you say qualifies for this, Jake? And then Pierce, I want you to touch on what you like best about the deferred sales trust.
Absolutely. The easiest home run to speak of would be $1 million net. Or when I say $1 million net, so we've got $1 million net proceeds from the sale after all, realtors and everybody else is paid. Talking about any callback depreciation that might be added to the mix or adjusted basis. And of course, we also have to take into consideration if there's any debt that might be called boot, added back as an economic benefit. Any of those situations add to an adjusted basis that we then offset with the sales proceeds, and we come up with a net, so to speak. And that's what the figure that we look at, the home run, $1 million or higher. That's a number that makes it really easy for us to say that, hey, this makes sense. That the pain of otherwise paying the tax is great enough and significant enough that we should probably all look at working together and seeing if we can have a better outcome.
Yep. And Pierce, as a reminder, who does this work for, and what do you like best about it?
I love best about it is it works for
I'm gonna take it back, Pierce, because it sounds like your connection's pretty poor there. So I'm gonna actually answer the question that I just asked of Pierce, since he's close to that Lake Tahoe and it gets a tough spot for his cell phone. So it works for anybody who has a primary home, a business, a piece of real estate, public or private stock, cryptocurrency, NFTs, artwork, collectibles. It can save a failed 1031 exchange. Yes, past the 45-day identification. You need to make sure you're working with a qualified intermediary that will accommodate. It's very important that you're working with those. I've had now 4 or 5 now in the past 2 weeks alone who have called me and said, "Hey, Brett, can we do this?" And I said, "Well, if you get what's your accommodator?" And they give me a couple names, and I'm like, if you can get them to work with you, because they're not very friendly to the Deferred Sales Trust, but we have very friendly 1031 qualified intermediaries. So you want to make sure you get with us on if you're going into one, and we recommend to not use one that's not going to allow you to have the Deferred Sales Trust option. So, but it works for, like we said, businesses, cryptocurrency, real estate, primary homes, and it's very flexible. Works for LP interest, GP interest. In fact, one of the live deals right now is for a repeat client, and they're selling another apartment complex. This will be their 4th Deferred Sales Trust, and they're going to be closing another 4 in the next 2 months alone. And their structure is 2 GP interest, typically. And now they have another 3rd GP on this next one they're coming in, and the rest of their LPs. And then as they exit, they assign their GP interest to the trust, because the whole entity typically in a 1031 exchange must move, but not so with the Deferred Sales Trust. This is why it's like Netflix and not like Blockbuster, because it has that flexibility. And so instead of paying tax on each sale, and then the partners coming together again for maybe the next deal that might not be within 45 days, might be at 181 days, might be whenever, they're able to exit their positions into the trust. Then they can always partner together as they partner with their trust to go buy more property. So it's kind of like a self-directed IRA. It's kind of like a 401k in one sense. It's kind of like a 1031. It's kind of like a lot of things. And you got tax deferral and you got some flexibility, but then you can also put it into liquid investment grade securities, which is nice. And that the funds can be invested with some of the biggest companies in the world. And this is where Jake Miller comes in. He's a financial advisor. So Jake, talk about the importance of diversification right now, liquidity, and put it again into assets that have some stability, because it's definitely the real estate world and the crypto world are some of the all-time highs.
Absolutely. And of course, just as a little disclosure, items that we might discuss today are not recommendations for anyone. These are for discussion purposes only. But essentially within the DST, there is a liquidity requirement that at any given time, we're able to show the IRS that there's a promissory note involved with this strategy, and that you're able to pay on that promissory note, because all of your assets are tied up in contracts, in loans. Not all of your assets are tied up in real estate. They're not all tied up in hard assets that can't easily be liquidated within, 3 to 5 business days. And so typically we maintain those assets. We don't like them to be idle in cash. We put them in the stock market and in marketable securities. We currently have been having several consultations with clients over inflation we're experiencing in the country from high inflation. Typically able to do that. And when I talk, we try to lower by picking high grade companies, blue chip, that are preferred stock, that also have a dividend. These dividends kind of are a little income engine. It's almost like having multifamily with your number of doors that you get rent from, right? But we're building safe and secure, less volatile investments inside of these portfolios based on the client's risk tolerance, of course, based on their circumstance and based on their overall investment objective. But from a corporate asset management standpoint, which is kind of how we treat this business trust, we like to have money available for opportunities. Should you want to use something other than that 20% that we retain for liquidity purposes for an opportunity investment in a piece of real estate, we want to make sure that you're not sacrificing pulling it out of a market that might be down to go and take advantage of a good real estate deal. And so we have several conversations ongoing with the trustee, Brett Swarts, and with the clients to make sure that their overall objectives are being achieved, and that whether their objectives are short-term or long-term, as well as the regulatory requirements of maintaining that 20% liquidity, that we're making sure that everything is taken care of.
Perfect. Excellent. Very, very well said. We want to open it up for some questions today, and then we'll be talking about our new guest next week, a surprise guest that I'll be talking about and highlighting here in a minute. But does anyone have any questions, thoughts, comments, hesitations is another one I've been hearing lately. We'd love for you to put it in the chat or just unmute yourself, ask the question, and we are happy to answer the question for you right now. I will give it a few seconds for someone to open it up. What do we got?
Brett, while we wait for someone, how's my sound? Is it coming through pretty good?
Pretty good. Yeah, it was a little bit broken a second ago, but then it came back pretty good. So, yeah, whatever service you have where you're driving. By the way, you were in Houston, right, for some kind of conference this week? How did that go?
You know, it was great. We had Ted Cruz come. I posted a little thing on my Instagram, just, him talking about politics and Bitcoin, and he's sponsoring a bill right now so that the federal government doesn't, I don't know what you'd say, create their own digital asset to try and create a central bank type scenario with cryptocurrency. Just a lot of different things that are affecting our world, from currency, from assets, from international money transfers to everything, right? And it was very educational, very insightful. We got to see a little bit of the hype, a little bit of the ego, as well as everything from the big manufacturers that do transformers to what we do with Moonshot Pods, one of our clients, right? And it was just a great environment to be with some of the people who are on the forefront of change, and have discussion with them, as well as get their take on what the future holds.
It's fantastic. Love that. By the way, you can start your Deferred Sales Trust today. You can go to capitalgainstaxsolutions.com, capitalgainstaxsolutions.com. Got the new book coming out. Guess who's in it? We got the Jake Muller, who you're hearing from in there, as well as Kevin Harrington from Shark Tank, and a number of other really smart people that I've been able to glean wisdom from in investing and in commercial real estate investing and different investing, all here building a tax deferred exit strategy. Look for that to hit Amazon soon. That being said, who has questions, thoughts, comments? You want to put it in there? We want to open it up for everybody. Otherwise, we could just, me and Jake and Pierce can just hang out and talk here.
Hello,
Dennis. Hello.
Yeah, I'm new to all this Deferred Sales Trust, and we're selling a house here in California. We're going to walk away with 1.2. I know there's a $500,000 exemption. So, are you saying that the remainder of the $700,000 will go into the Deferred Sales Trust, and I'm allowed to dictate how much money I want to be paid each month? That's right. Yeah, just how much am I allowed to dictate to you guys how much I want? That's pretty much what I'm going to say.
Great question. Can I ask you just a couple questions, and then we can kind of map it out a little bit here, Dennis?
Yeah.
Okay. What's the estimated sales price of the property?
2.3.
Okay. And so is the debt? What's the debt exactly?
1.1.
Okay. And what did you buy it for?
Same 1.1.
Okay.
1.1. Yeah.
And have you put any improvements into it?
Probably about 25,000.
Okay, so it's just basically 1.1. And you lived there 2 of the last 5 years, correct?
Yes, I have.
And you are married?
Yes.
Okay, so you have what's called the 121 exclusion, like you referred to, right? Where you get $500,000. The way we like to do the math here, to keep it simple, is just take that 1.1 million plus that 25,000 of improvement plus 500,000 is the 121 exclusion, and let's call that your basis, your kind of your, it wouldn't be necessarily an adjusted basis because you're not depreciating anything, but it is essentially the true basis of the property. Okay, so 1.125, and then I'm adding the 500,000. So that gives me about 1.625. Do you understand where I got that number first?
Yes, I do. Yes.
Okay. So then I'm taking the 2.3 million. Now, is that 2.3 million before commissions? Because you might have to pay a realtor to sell that?
Yes, I figure about 35,000 commission because I'm a broker myself.
Okay, perfect.
So
So
I'm
we'll
just
just put, excellent. You're a broker yourself. By the way, where are you located, Dennis? Can you hear me okay, Dennis? Where are you located, Dennis?
Pismo Beach, California.
Oh, Pismo Beach. Excellent, excellent. So we're taking the 2.3, Dennis, minus the 35,000. So now you have 2,265, and then we're going to minus the 1,625, and that's going to give a $640,000 gain. Okay, $640,000 gain. Now in the state of California, plus federal, you're looking at 20% federal, 13.3% California for 33%.
Well,
okay. So you're looking at a tax bill of approximately $211,200. Now, of course, we want you to check with your CPA, and each individual circumstances vary, and you want to get with your CPA on that. But that's just a general estimate. Do you understand how I got there?
yes, I do. Yes.
Okay. So let me ask you a couple other questions. Do you need or want any of the funds for another purchase of a primary home or big personal expense? Go buy a boat, go, whatever. You go, travel the world. Like, do you feel like, hey, Brett, I'd be happy if the money could hit an account that I could retire on or get some cash flow on or put in some investments. Does that make sense?
Yes, I like to get 500,000 up front.
Okay.
That's the exemption. I'm going to purchase another house in Las Vegas,
Okay.
primary.
Okay. So you say you'd like, which is a key. It's a key word there, right? Because would you be open to a way to perhaps get a down payment somewhere else if it's even available, and then using the trust as a way to fund or even dollar costs or debt snowball that debt? Or is this something you say, Brett, I absolutely need that 500 no matter what for the down payment?
I could probably reduce it to 250
Okay.
and then have other funds available.
Okay.
And then let the other money ride.
And let me explain the reasoning behind this, right? Because right now, this is a Rubik's Cube that we just kind of started to put together here. The biggest thing that's blocking us from getting this thing congruent is this $211,200. Or another way to put it is a 33% gain. And so interest rates are pretty low. As you know, you're a realtor, right? You can probably get a house loan for somewhere around 3.5%, 30-year fixed, right?
Yeah, 3.25, right.
Yeah, so right around there, right? So think about this. So if I came to you and I said, Dennis, you can go borrow at 33%. Would you do that deal for a house loan? You'd go, that's crazy, Brett. I probably wouldn't even be able to afford it. And so I said, well, if there's a way to get a down payment somewhere else, potentially, right? And you may not have an option to do that, but for every dollar that you're going to pull from this, you're going to pay 33%.
Right. Yeah. Yeah.
Okay. So one of the common asked questions, and people are probably thinking like, well, Brett, can't he just take the 500 because that's tax-free money, right? Yeah. Well, you can if you take all of the money at closing and take all of the, all of the cash, pay off all the debt and just take all the cash. You get that $500,000 exclusion, but you owe that $211,000. Yeah. So in other words, you can't have your cake and eat it too. You can do one or the other. You don't lose the 500, but you do take it in proportion to your basis. And so one suggestion, Dennis, to map out would be to say this. Dennis, can you get a down payment somewhere else? And by the way, what kind of property do you want to purchase? What do you think the Las Vegas property, what's that going to be approximately worth?
1.3.
Okay, so you already know 1.3. Okay, and then the next question would be: you want to put 5 or 10% down, or what's the comfortable amount there?
Well, I was going to put $500,000 down to keep the payment low. But I could probably get away with 250, 20%.
Okay.
Around there. Yeah.
Yeah. So like 260 is 20, 260. Yeah. 260 is 20%. Okay. And then again, is there any chance you can get that 260 somewhere else? Could you?
I'd have to apply for an equity home loan. I'm retired, by the way.
Okay.
So is my wife. So it's a little bit more difficult for us to get loans now. I was thinking about doing an equity line on this house before I sell it and stash that money away.
Now you're thinking, well, do you have some time? Like, you're not in a rush to do this? Like, you have some time to do this?
Yeah, right. No.
Yeah, so to the extent that you can do a home equity line of credit up into your basis, remember what I said your basis was? And again, check with your CPA on this.
Yeah.
But I said your basis is basically about 1.6, right?
1.6, right.
Yeah. And so you said you owed, so this is option one. I think I'm liking this now. I passed you the cube, now you're passing it back. You owe about 1.1, okay? So that gives us about a $500,000 difference, okay? So what about this? What if you could get a home equity line of credit for 260 or even potentially up to 500,000, okay? Check with your CPA and make sure that upon the exit, you'd be good here. And we can also get with the tax attorney on our side to map this out, okay? But what I'm seeing is you could borrow up to your basis, okay, or do a home equity line of credit, and then at closing, you're going to pay off all debt.
Yes.
Okay. And you're going to have, let's just say, to keep it simple, let's just say you're going to have 250 in the bank. 250 in the bank that you borrowed up to. So we went from 1.1, we added 250. So we're at 135. 135 is the debt to pay off. Okay. To pay off. And we sold for the 2.3 or so, let's say net of closing costs or whatever.
Right.
So you're at 950 is the net proceeds.
Okay.
And we just deferred $211,000 of tax.
Right.
And by the way, I like that deal better now too, because your 211 divided by your 950, it's a pretty good ratio. It's about 22%. It's a healthy ratio. We like to see 15, 20, 25% on whatever the tax liability you would have paid in comparison to the net proceeds. In other words, you wouldn't want to put 211 in deferral and have 5 million of net proceeds. That's not a great ratio.
Right. Okay.
But 211 on 950, Dennis, is a good ratio. That's a healthy ratio. Plus, you still have your 250. Remember that refinance or that HELOC was tax-free. Right, for your down payment. Then we turn around and we immediately pay off all of the debt at closing.
Right.
And you have that down payment there. And now we have $950 to work with. So now, any questions on that before I answer your question about how we can structure the promissory note?
No, I understand so far. I got it.
Anybody else have questions on what just happened? Because Dennis is a realtor for many years and he's got it really fast already, I can tell. But someone else on this call on the Zoom might have some questions. So what questions does anybody have that I just said? Anybody? Or Jake, maybe comments.
Yeah, so actually, Brett, I was thinking that maybe if you could recap from start to finish what just happened, I think that might be good for people who maybe got lost in between to see how they can connect all the dots.
Perfect. Yep. So let's recap. So Dennis is selling his house and he's been married, lived there the last 5 years, and he's seen a substantial gain. In fact, his gain, he bought it for $1.1 million. He's selling it for $2.3 million. And he's looking at a capital gains tax, even after his 121 exclusion, of about $211,000. Now he's retiring, and this is important for him to have an extra 211 working for him. Potentially, I'm assuming, or at least he wants to have that so he can live off some cash flow. But his challenge is he also wants to buy a house. Now, the Deferred Sales Trust cannot partner with you to buy a primary house. It's taxable. That's the tax portion of it. However, if before he closes escrow, and even before, you can't have cash at closing either. It has to be truly a HELOC prior basically to the transaction. This is also an important fact here. He takes a cash out refi and or HELOC of $250,000. This is the number we're working with here, which still maintains within his basis, which he will need to double check with his CPA, and we'll get on with the tax attorney and Jake and I on another call, Dennis. We can all go through this together.
Yeah.
If everything lines up and we do this correctly, and also Dennis has time here, the final outcome will be about $950 into the trust. He has his $250 for his down payment, and he has an extra $211,000 that's going to be invested in cash flowing producing assets and in retirement income. So that's the overview. Jake, did I do a good job there? How does that sound?
You did perfect. You did great. I think that shows how the Deferred Sales Trust is not a cookie cutter thing, but it's something that can be customized and made and tailored to fit somebody's scenario, or utilized in such a way that somebody like Dennis can have a better outcome than otherwise. I would also add, Brett, that based on the future revenue that somebody receives from the trust, that shows as revenue for lender-worthy purposes, I guess. Somebody's looking at you and looking at where your income's coming from and everything else. And if you've got a steady stream of revenue from the trust, banks also recognize that as something that they can lend off of. Even if it's not lending off of the trust, you're not pledging the trust assets as collateral, but you're showing an income stream.
Absolutely. That's a great point. In fact, we had a client who sold a Walnut Creek commercial property, and they wanted to buy, this is so funny, Dennis, check this out. They wanted to buy a condo in San Luis Obispo, a $1.2 million condo. This is about a year and a half ago. And they called me up and like, Brett, we want to use the trust to buy the condo. I'm like, well, is it going to be a primary or an investment property? They said, primary. I said, well, we can't do that. Like, I mean, we can cash you out and you can do down payment and then you can pay tax on that. They said, well, we don't want to do that. And I said, okay, well, how about this? How about we get the payments going, which we basically turned up the payments higher to get some cash flow from the trust in order to qualify for a loan, because the bank said, hey, we need about $6,000 more of income per month for you to qualify for the loan. And they said, great, well, let's get $6,000 more of income per month. So we were able to kind of refinance the promissory note, which kind of answers your first part of your question. We're able to change that along the way. And so we typically, when we set it up on this 950, you could say, Brett, I'd like to have X per month. And I might say, well, Dennis, would you like X per month right now while you're in San Luis Obispo? Or would you like X per month once you establish residency in Las Vegas, Nevada? And you might say, you know what, Brett, I'd like to establish residency in Las Vegas, Nevada. And I'm going to say, that's probably a good choice, Dennis. Well, why don't we delay that income for a year, get you settled over there. And in the meantime, the funds can be invested in growing and building, and then start receiving income once you establish residency in Nevada. And you say, Brett, that's one of the best thoughts and tax flow strategies I've ever heard. I'm going to say, yes. And that's what you can do with the Deferred Sales Trust. It's flexible. It's also adjustable depending on your circumstance and your timing. So back to this other client, they were still living in California. And they said, you know what? We need it right now. How quickly can we adjust it? So we can adjust it here in a week. Let's get the payments going. And so we adjusted it, and an extra $6,000 a month starts coming out. And guess what the bank said? We just need basically 30 days of that. I think they said maybe 2 payments, and then we're going to qualify that as your income. They also see statements of the trust. In this scenario, they're at TD Ameritrade Charles Schwab, so they saw all of that, and they're like, "Yeah, this is good." So, does that make sense, Dennis? So far on all of that, or any questions there?
That makes perfect sense, because I've actually talked to a lender who suggested that. He said, start the payments from the trust, or at that time, annuity, and like a cash flow recorded for 3 months, and we'll add it to your income you have now. So he suggested 10,000, but I'm not too sure I really need that much. I make 10,000 now a month, so I think another 5 would probably do it, and then show 3 months statements and a statement from you. And it should be able to qualify for the new house.
There it is. So that's the Rubik's Cube analogy, right? So
Yeah.
you're passing it to your lender, you're passing it to your CPA, you're passing it to me and Jake, we're passing it to the DST tax attorney. And if we all get in the room, and as long as we have some time to do this,
Yeah.
we adjust this thing, and ideally it gets congruency on every side. Does that make sense?
Yes, it does. Yes. Thank you.
Thank you. Yeah, I appreciate you jumping in here because that's a great case study for everybody to learn from. And everyone, if you didn't quite get all that, it's cool. It's live on YouTube right now. You can go back and you can rewatch it and rewind it and rewatch it. And if that hopefully that clicks. And what we're talking about here is tax flow, not just cash flow. It's both. And we've got to try to take this, again, this a Rubik's Cube. By the way, I ordered a Rubik's Cube this week, Jake, on Amazon. And so I'm hoping next week I'm going to have this thing, and maybe I should put like tax flow on one side and cash flow on one side, and we can like adjust this thing. And that's the cool, we like solving problems, and we like geeking out about tax and cash flow and investments and helping people have freedom with their finances, freedom with their time and the location freedom. In fact, Dennis, we just did a deal in Palo Alto for $8.3 million. And guess where he moved? To Nevada, outside of Las Vegas, Henderson, right? Yeah. And he could not even sell his property without the Deferred Sales Trust. I mean, he had about an $800,000 to $1 million liability. He goes, Brett, without this, I can't even sell. Because I basically, everything goes to zero. Like after I pay off my debt and I pay the closing costs and I pay the tax, like there's no point for me to sell. I might as well hold on to the property. And he goes, with it, I could sell, I can exit, I can retire, I can get some cash flow coming in, I can defer the tax, I can land in Nevada, a very tax-friendly state, and start to receive cash flow from that. He did a mixture of both. He actually had to take a payment at the close for his down payment. He didn't quite have any other option because of where his basis was. But these are the things that are we're doing every day. So any questions or thoughts from anybody? Cool.
One more quick question, Brett.
Sure.
When you take the money and put it into a trust and you invest it with TD America, you said?
Yeah. So with Jake Miller, it's at Charles Schwab. Oh, sorry. Go ahead, Dennis.
Okay. So what interest rate are you shooting for? And with the stock market being the way it is, what do you invest in? Or do you just guide me to invest for myself, or how does that work?
So we work together as a team. We take down a lot of information. We actually do not just a normal risk tolerance questionnaire, but I kind of call it a survey because it's how you would feel should the market do certain things type of survey. And then in addition to that, we set objectives. And so for you, it's a little different than other clients that are wanting to continually reinvest. For you, if you're wanting an income stream from this, we would, based on the scenario I painted early on at the start of the meeting, if we had, let's say, preferred stock that had income coming in from the dividends monthly, we would measure that against what your monthly income need is and just try to see if from that alone, right now, bonds are pretty tough to work with, pretty tough to have confidence in with interest rates doing what they're doing and inflation doing what it's doing, right? So we need an inflation hedge. We need to be able to retain your principal as much as possible. We need to satisfy your income needs. And we want to combat, depending on your risk tolerance, we need to combat some of the volatility that's going on because of politics, because of Russia, because of everything else, right? And so it's a little bit of a journey. At the end of the day, you're the CEO, Brett's the COO, I'm the CFO. We're all here, one team. We're working together. So your input and your dialogue is critical. We do things for you though. We try to make your life easier. And of course, it's all based on our discussions that we have, what actions we take.
Okay. All right. Thank you.
Yeah. And for those who are wondering, our promissory notes are typically structured based upon a risk tolerance, but around 8% net of recurring fees. That includes Jake and my fees. There's a one-time fee that's paid up front to the tax attorneys. That's typically about 1.5% of the gross sales price. But we only ever get paid if and when the deal closes. So it's all conditional. But upon closing, Jake would manage the funds, and then based upon the risk tolerance and based upon the approval of both the trustee and, in this scenario, Dennis, you. And the payments can be structured flexible. It could be interest-only payments. It could be partial interest payments. It could be interest and principal. It could be delayed for a period of time. And then payments can come out, and then you pay tax on that, and you'll get a 1099 on that. Pretty simple. You report to your CPA. If you dip into principal, you report that as principal payback or received, and then you'll pay some capital gains tax on that. And then you just get a 1099, and you just report that. It's really simple. As a trustee, I file the tax returns with a professional preparer for that. You get to review all that. You get 24/7 access to do the funds online. We all work together as a team to make all of this, okay? But it's like riding a bike. The first time you're riding, you're like, well, this is wobbly. Who are these new people with this new tax deferral strategy? And I've never done it before, and it's my biggest sale. It's my retirement. It's my future. And all of a sudden, we're talking about tax, and we're talking about investments and retirement, or if you're an entrepreneur, you might say, I want to go invest in another piece of real estate. Can I do that? Well, yeah, as long as it's investment real estate, that's good. Or another business, yeah. We just did the Bitcoin sale for the client, Jake and I, for the $5 million I was telling you about, and she did a startup, a tech company, of another client that did an Ethereum sale for $7.5 million and Bitcoin out of a $13 million gain. And for him, he's going to be starting a crypto business, serving that community. So these things are all possible, and the key is just getting with us. The timing is crucial, though. We don't want to exit before we have a plan in place and before we have the trust in place. In fact, we typically say don't even list. Don't even, go to market, because if you go past a certain time period, which basically means a buyer removing all contingencies, it's too late. And or if you're not, unless you're in a 1031 exchange, in which, again, we can save if you're using the right accommodator. So all of these things, all no cost, no obligation. Get with us early. We will connect you with the right people, the best in the business on M&A advising, by the way, financial advisors, luxury realtors, commercial real estate brokers, business brokers. We have the network and the connections across the nation to help you every single step of the way. And the key is bringing all of the team together around the Deferred Sales Trust, because that's the big elephant in the room we're trying to solve for, and making sure that we do everything precisely as it should be, so that you don't run out of time or you don't miss a step, and so that you can defer all the tax. Does that make sense, everybody? Any questions on that?
Brett, I do have a question for you. When would somebody want to pull out of a deferred sales trust, and why would they want to?
Yeah, good question.
Yeah, it's a great question. So most of our clients who are wanting to first of all, 99.9% they stay in. I think I had one go out last year. Part of it because the tax liability was pretty low. She was actually a realtor out of the Bay Area. And, we said, it's a base hit double maybe on the deal. The tax liability wasn't that big. And so we said, perhaps, given your circumstance, and they were pretty wealthy already, we said, hey, you can go one way or the other. But most of them won't. The only time you might is if you want to personally buy a home or personally travel around the world or spend the money on just a boat or something personal, like you need the big amount of cash. If that is the case and the intent is just to spend it on personal stuff, then you don't want to use the trust, because we can't defer personal use of the funds, right? Now, for those that want to, that'd be the main one. I mean, Jake, can you think of any other ones? Why else would you want to get out of the trust?
Yeah, so essentially anything that you want as a physical, tangible asset to stay in your estate that you want to do something with today. So buying, as you mentioned, personal things like a cabin for the family use, not short-term rental use, but for the family only use, exclusive use. If you're going to buy a little jet for your business, there's ways to properly do that through a joint venture and through outside LLCs that partner with the trust. But if it's a personal jet that you're just going to fly around your family with, then no. So again, it all goes down to the purpose and objective of the asset that's being acquired. And if it's for reinvestment purposes in that business trust, not personal in nature, then we're good to go and continue to use the trust. And should it be taken out as a personal thing, which is okay, it's perfectly fine. We can do that. If overwhelmingly the large bulk portion of the assets are being used for personal stuff, then maybe we should reconsider what we're doing with the trust. We should possibly, finalize it or have an exit strategy in place so that we can exit it in a more efficient way. Or if we're considering it from the very beginning and we're considering it while having in mind a lot of personal use, we need to weigh the pros and cons of this versus other strategies. Again, at the end of the day, Brett and I, we try to make sure, first and foremost, that people are eligible, that they have an eligible transaction, that this is a proper use, and that what their long-term objectives are. I mean, is this a 5-year thing? Is this a lifetime thing? Is this a legacy thing? It can serve all of those purposes. But of course, the more short-term you get with it, the more we have to kind of scratch our heads and wonder, is this the right tool?
So Brett, it kind of sounds like the main reason why someone would want to get out is for some sort of like personal use of the funds. But couldn't the trust's cash flow just kind of cover that if like whatever you're going to do is going to have some sort of like loan or with like a lower interest rate? Like, wouldn't it make sense to keep that in there if you're getting 8% on your money versus like a 4% loan?
Correct. Exactly right. So most of our clients will just live off the interest of the payments, right? They'll take somewhere between 5 and 6% payout and have the 8% cushion or the 2 to 3% cushion. By the way, the notes sometimes are 7, 6, and 5, depending on the risk tolerance, depending on a number of, basically the risk tolerance score. So, and then our goal is to net of fees, net that 8, 7, or 6 or 5% number. Most of them are at 8% for generally speaking, but right. And then they live off 5 to 6, keep a little cushion there. And I call it, don't eat the goose that lays the golden egg. Our goal is to keep the golden goose. Like in Dennis's scenario, it'd be about $1 million is in the trust. And let's say it's earning 8%, which is 80,000. Let's say he's living off 50,000 per year. He's keeping an extra little cushion of 30 that just always keeps that original million, the golden goose, building to be able to lay the golden eggs, right? And so that's the whole idea. In this scenario, he has an extra 211,000. So he's really happy. We're happy because we get to serve him, help him out, make our fees. And he has the wealth that he can pass on to his kids. Every 10 years, you can renew for 10 years. Kids can step into your shoes and you can keep it going.
Brett, I had a question come to me, and I can't remember the exact number. They asked what the minimum attorney fee would be. Should this not be a home run deal, but less than a home run deal, less than the $1 million mark? Is there a minimum attorney fee that you're aware of?
Right. Great question. On the gross sales price, I think it's $5,000, maybe $7,500 is the minimum.
Okay. Yeah. I was guessing at 7,000, but five to 7,500, probably a pretty accurate guesstimate, I guess.
Yeah. All right. Anybody else have any other questions? And if you want to get started, you go to capitalgainstaxsolutions.com to get started for a free consultation. You can apply to see if it's something that it would be a good fit, and we can find out.
Thanks, Brett. Very good.
I have a question, Brett.
Sure.
So can you leave your funds in there and not receive any payment and just have the 8% add to your principal investment to keep growing that 8% on a yearly basis?
Yes, you can. The question is, when do we want to start a payment? Typically, we want to start something out within about 2 years. We like to see some payment, some amount of that 8 going out. But that is one of the advantages of delaying payment for a period of time.
And how come you want to start payment after 2 years?
So we found that the guidance is one that you want to make sure that we're staying within what would be considered commercially reasonable amount of term to actually receive payments back. So it's not like a hard and fast like you have to do these things, but over the years, as the audits have happened and as little clues that we've seen, we want to make sure that we have some payments coming out is the general feedback that we've got from the tax attorneys.
That makes sense. Thank you.
You're welcome. Anybody else? Questions, thoughts?
Brett, one last question.
Sure.
This is Dennis again. My wife reminded me that we talked to our CPA a while back about this program, and he said if you can dictate the payments, it's not actually a installment program or something like that. So he said it might not be legal in California too.
Yeah, great question. So let's define the word dictate, right? So yeah, it is a negotiation, right? So Dennis, before you and I, anything happens, you're saying, hey, Brett, here's my risk tolerance. Here's the sale. I would like to have this amount. And I say, yeah, it sounds pretty good, Dennis. I think that sounds pretty good too, right? So it's not a unilateral control. It's a secured lender control, right? And so a lot of CPAs that don't know about this have never done it. I've never had a CPA do it. They're looking for the reasons why it's not going to work, but yet thousands of closes, billions under management, and they always go to the worst case scenario, like, oh my gosh, like, because they don't want to be the one who says yes to you, Dennis.
Right.
And being that they've never done it before, it's like a surgeon, right? He's been your general practitioner, and you come in and like, hey, I want to go get ACL surgery, and they didn't know how to do ACLs 50 years ago. And he's like, well, man, I wouldn't do that ACL surgery. He's going to open you up, and there's going to be infection and all these different things. And you're like, well, what if there's been thousands done and billions under management and over a dozen no change IRS audits and multiple audits in California, and there's all been no change audits, and it's literally a perfect track record, right? But the CPA, he has no upside. So he says yes to you. Let's just say he goes, yeah, that sounds good. I've never done it. I don't know how to do it, but I say yes, and it works. Does he have any really upside to that? Maybe not. He still does your tax return or whatever. Now the opposite is true though. If he says yes and it doesn't work, then all of a sudden it's like he's on the hook for this thing, right? Or he's responsible. Right. So we've found that the CPA who helped you get from 0 to $1 million, or even 1 to 10 million, Dennis, is not the CPA to get you to the next level. And this is where we bring in the best of the best. We call them the dream team. By the way, the guy who created this is a CPA and a tax attorney. Okay, the biggest audit was in California, $128 million deal in San Diego, which was a no change audit. Another big deal just happened in Santa Barbara, a $46 million primary home sale, where this is a very high net worth individual who hired a California law firm to do a 3-month due diligence on this and paid him $100,000 to this law firm on this exact topic you're bringing up. And they said, green light, go for it. You're good to go. So we also, by the way, we encourage you to bring him to the call, right? Don't let them off the hook. Say, hey, you have some really good questions and thoughts. Come talk with the CPA and Brett's team. Come talk with the financial advisor, Jake Miller. By the way, Jake Muller, I'm going to tee him up here. Jake, he actually, I call him the CPA whisperer, Dennis. You might not know this from the other calls, but he actually trains and coaches thousands of CPAs over the years. Jake, you want to touch on that and any comments on this?
So I've had an extraordinary opportunity to participate in an association that is rather large, over 10,000 CPA firm owners, and I was assigned to the top 400 in the group that paid the highest dues, where every Tuesday myself and another fellow named James Rainwater, we would take questions and provide answers. And sometimes we didn't have the answers, we had to go find the answers, right? And it was quite an arduous thing to have strategies thrown at us from every little attorney seminar out there that somebody's client went to. And 19 out of 20 of them were way too fishy, or they didn't have substance, or they didn't have precedence, or it was just somebody's idea and it had never been tested before, right? And that's not the case here with the Deferred Sales Trust. Out of 423 strategies, there were only 2 out of 423 that have a perfect track record with the IRS, meaning that they have not been disallowed. They have not been abused and manipulated and changed in such a way that they've been disallowed. And the Deferred Sales Trust is one of those 2. So very, very exciting opportunity to be a part of that. Open to working with other professionals. We're not here to step on their toes, but to educate them and to help them. Sometimes there's a level of awkwardness where, they feel like they should know this already, or, why haven't they seen it before, etc. And as long as we can get them past that awkwardness or sometimes the competitive mindset, and let them know that we're all on the same team, usually if they'll ask the questions that they have in a professional manner, we can show them the documentation, we can lay it all out for them. And I would say 9 out of 10 times they nod their head and say, now I get it. This makes sense. And actually, this seems familiar to me now. And there's a lot of the light bulb turning on type moment, so to speak, for those people who a little bit more humbly come to the table, willing to discuss professionally what we're trying to do for all of our clients.
Does that make sense, Dennis? Any questions there?
No, I'm okay. I understand.
Cool. Awesome, Dennis. Thanks. Good question. And by the way, also lifetime audit defense for the tax attorney. So Dennis, did you get state or federal audit on any of the trust part of the transaction? They will defend at no additional charge, which is pretty cool. And remember, all this is conditional, no cost. You can do all your due diligence with us, bring your CPA to the table. We form the trust. We work with your escrow company. We work with title.
Okay.
We get everything in place. We help with you as the realtor to put the addendums in place. All of it. And for some reason the deal doesn't close, or you want to pay the tax, like you owe us zero, right? There's no obligation to this. So that being said, if anyone wants to learn, you go to capitalgainstaxsolutions.com. And Jake, we're running out of time here. So if people want to get in touch with you, where is the best place for them to find you?
Yeah, we've got an 800 number, 1-800-773-1848, as well as we have a new landing page for our website that's under construction. But it is strategictaxsolutions.com, strategictaxsolutions.com. My email is jake@strategictaxsolutions.com.
And then look for the book that's coming out soon, Building a Tax Deferred Exit Strategy. It's the proven playbook for unlocking your ideal wealth plan when selling assets of any kind for yourself or your clients. The Jake Miller will be in it. I'll be in it, as well as the Kevin Harrington from Shark Tank will be in it too. Hey, I want to thank Dennis for being a part of it. Dennis, I appreciate you sharing all of your current circumstance. We're happy to help you out. Let us know if we can help you out. I want to encourage you to invite that CPA to come to this next week, or anyone else. Invite the CPA, invite the skeptical person. We're on a mission to train and coach 100,000 of the top business professionals across the U.S. on this strategy. And we want you to be a part of the mission with the Deferred Sales Trust. Go to capitalgainstaxsolutions.com to register to be a part of this Zoom if you're watching this on YouTube or Facebook. And we look forward to seeing everybody next week. Pierce, you enjoy that Lake Tahoe, and maybe do a DST man on the street if you can on the Tahoe side.
Thank you, guys.
All right. Take care, everybody.
Off to link up with Rebecca.
Exactly. You should. Bye, everybody.
Have a good time, everyone.
Okay.
Great weekend.
Bye now.